Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of experts. And today we have very much a financial slant on the programme. I'm joined by Humphreys, CEO of Brickflow, the digital marketplace for property finance. Welcome to you.
Thanks, Stephen. Thanks for inviting me on.
Good. Well, it's your first time, so we'll try and be nice.
Thank you.
Okay. And joining in is Jamie Pritchard, Director of Glenhawk Transitional Finance Providers. You love me saying that, don't you?
I do, Stephen, yeah. Hi.
Just shows we're on the mark, doesn't it?
Yes, it does.
Yeah, good, okay. Just for our viewers' point of view, that's bridging finance.
Bridging finance.
Great stuff. Okay. Ian, we're going to let you go first today. And the question is this. As a developer, I'm of course nervous about the rate of increase in construction material costs. As I've not yet started my latest project, would the financiers recommend I delay the start until prices settle? And if so, when in their opinion would that be? Now, I do know a little bit of the background to this question, Ian, and I think it's asked in the light of the knowledge that a number of developers, especially in this part of London where construction and development is rife, a number of developers are pausing their developments to see what's going to happen, because obviously if you're doing a £500 million block and you get halfway and your materials double in cost, you're in trouble, aren't you? And of course that would come back to you as financiers to deal with, I suppose.
Yeah, I mean, I think the material costs definitely have started to come down. If you look at where build cost inflation was a year ago, so if you look at the indexes, BCIS, etc., then build costs were annually, the inflation rates were enormous.
Right. What are we talking about there?
We're talking sort of like mid-teens, month to month.
Okay.
Whereas now I think you're sort of single figure percentages. So we're still going up, but just at a much reduced rate. So I think June was the peak for build cost inflation. But I think you've also got to look at the constituent parts. You've got materials, but you've also got labour. What was particularly pleasing about the budget recently was that they're now reducing the barriers to entry for skilled construction workers.
Right.
So I think construction labour, the cost of that will reduce. I think the other thing that's coming into the market now as well is, as we perhaps come into an economic downturn, that contractors are now looking to bring more into their pipeline. So they're becoming more competitive. I speak to developers. I have a lot of friends that are developers. So speaking to people most days, and I think if you speak to them about what was happening a year ago, they couldn't get contractors to call them back, let alone give them a price on a contract, because there was just so much demand. Whereas now there is the sort of coins flipped, and now contractors are trying to be more competitive. They're trying to stockpile their pipeline. So I think with that brings its own problems, because then obviously there's delivery. Can they deliver that contract at the price they're stipulating? So you then need to start looking at the risk of that contractor being able to deliver at that price. Do they have the balance sheet to support it? But I think overall, if you're a lender, you're never going to say to people to not construct because of build costs. It's about understanding, I think, all the risks that are there. So build cost is just one constituent part. Yeah, there's so many other factors that you need to think about as a developer. So yeah, build costs might be going up, they might be coming down, but financial costs are going to move as well. GDV is going to move. There's certain things you can control, there's certain things you can't control. And ultimately, I think if you can't afford for your cost to rise by a certain percentage, then you've paid the wrong price for the land. That's what it comes back to.
I think in some ways, isn't it a little bit like, the buy-to-let investors? One of the classic things they do is forget about something called voids.
Yeah.
They say, oh well, it's £500 a week times 52. No, it's not, because you're going to have voids in that.
The good bit is, though, the lenders don't forget about voids, so we factor them in.
Well, you do, but again, that's coming to my question really. I'm just wondering whether we're going to start seeing financiers saying to developers, have you built in a position of prices going up more than this percentage of today's rate? Are we going to see that? Are we going to see financiers start insisting on that as part of the presentation for the loan?
You have already seen that. So historically, a 5% contingency within build costs was widely accepted. You'll struggle now to get any lender to accept less than 10%. So that's already been factored in. There's fluctuation clauses within the contractor's agreement now as well. So certain materials, they will guarantee a cost on. Others, they'll want the ability for that price to be able to move through the period of the contract. So I think for a lender, the two things I'm looking at really are, have you built in enough contingency, the what ifs, the risk that prices could go up, but also the strength for your contractor, your partners. Can they deliver at the price that they're saying? That's where the risk is. Build costs can move, but can your contractor deliver that contract at that price?
I suppose also we've got to take into account not just the cost of materials because of either shortages or increased energy costs making those materials, but we're going to see, I mean, Syria and Turkey have suffered these terrible earthquakes. There's going to be huge reconstruction required there, and presumably that's going to attract international contractors, both from this country and others. That's going to cause a shortage of materials, or at least put them at a premium. Yeah. And the same, and of course, I mean, the war eventually will end in Ukraine, and it has got to be rebuilt. Now, whether, as some of the news stories are saying, Putin's already made the plans for how he's going to redevelop Ukraine, nevertheless, whoever does it, it's going to need redeveloping, and again, a stress on material, isn't it? I think. What do you think, Jamie?
Yeah, definitely. We've talked about before on this program about the stress that the war is going to do and all that. But it's down. I think back to the question itself is that the investors asking
That's
is the time right now.
That.
I know. But I thought I'd jump in. The investor, is it right to do it now? They have to really think about their own circumstances. So you're just mentioning Turkey, Syria, Ukraine. There's going to be another one of them next as well, isn't it? So you can't keep on delaying your business plans because of them. All you can do is put them into considerations and into your due diligence and putting in sort of 10% that you're going to have there to think about, or you're going to actually think about the fluctuations in the material costs, all the considerations you should be doing at the start. And the lender will be thinking of that with you as well. So we just won't leave you high and dry. We don't want to lend you money. We could lend money very easily to everybody. We want to see it come back in as well.
Okay, well, 10% seems to be the figure, doesn't it?
It does.
But there we are. Okay, Jamie, your question. Given that we're at the moment unable to know for sure whether interest rates have peaked or not, would it be sensible to take out bridging finance on a development programme prior to locking into long-term finance? I guess the real issue is whether the extra costs of changing finance sources midstream is worth the gamble. What do the panel think?
Okay, so I think I'm a bridging lender, so I should be a massive promoter of, yes, use bridging finance all the time, but that's not the case. It's about using it in the right circumstances. So your question's asking, should I take out bridging finance instead of development finance and then, see what happens down the road? Well, there could be dual prices for actually the arrangement fees, because if you're taking out my bridging finance and exiting it with the development finance are going to have their fees as well. So you're going to have dual legal fees and all these professional costs, which are going to, guess what, eat into your bottom line and profit. So bridging should be used really when you've got the plan. And I always talk about the plan, really executing your plan. So what is the plot of land that you're looking to develop at the moment? Now, if you're trying to secure that and acquire that because you're trying to beat the race and somebody else to get that, then maybe bridging finance is the quicker option to secure that at the moment, and you can exit with development finance. Maybe you're taking out bridging finance probably because you want to change either the plans on site. So maybe bridging finance is the right before you secure the development finance. Actually, bridging finance is used quite a lot for taking out development finance. So it's used as a development exit sort of bridge to allow you more time and potentially cheaper costs at the back end as well.
To finish your sales program.
Yeah,
that's
absolutely.
Yeah, it's to stop you having to fire sale.
Yes.
Nobody wants, and also flooding the market with a product. If you've got 30 units, delivering them to market at the same time might not be what the market wants. So if you can drip feed them into the market, you can keep your prices at a higher level as a developer.
Yeah. I was interested in this business of getting to the end of a development and you're selling off your product. Do financiers, I'm going to I don't mean in any sort of subversive way, but do they, without involving the client or the borrower, sort of do a perhaps even a desktop valuation just to see how they're standing 2 years on from the original?
Well, with developments, what you'll be doing during the build itself is either having a sort of quantity surveyor or an asset manager going out and looking at the build, depending on the sort of size of the build itself and the level of that. So you've always got an idea of what that is doing with itself anyway. But what a good financier, as you say, a good lender will be doing during the course of the loan is actually working with the borrower to find out, how their marketability of them, well, if they finish the builds, first of all, the marketability of those and what they're looking to do as the exit. So it shouldn't come as, I suppose your comment sounds like it's a bit of a shock, and at the end you're doing a desktop on them. Of course, you've got that in your arsenal that you can actually do, but nothing should come as a shock if you're working with that borrower correctly all the way through it.
Yeah, I think with when you start looking at term products, a lot of them do have written into the agreement that the lender at the borrower's expense can have a valuation each year or every 2 years.
When's it not at the borrower's expense?
Well, yeah, always, right? But you've got to cover everyone's risk as the borrower. But that's definitely in there. But I do think in shorter loans, and I think just as things always become more professionalised, more institutionalised, you're always going to look to try and minimise risk as a lender. But I think, as Jamie says, if you're working partnership with a borrower as a lender, then there should be no surprises, right? But you do have to have a bit of a crystal ball as well, especially development where it could be 2 or 3 years. The GDV is a bit more of an unknown. I think with bridging, where it says 6 to 12 months, you should be relatively confident with GDV.
Yeah.
But I think 2 to 3 years is.
I think going back some years in sort of perhaps more sensitive times over lending and borrowing, sometimes you can actually have a financier cause the developer an unnecessary problem by being overcautious 3/4 of the way down the line and actually facilitating a problem rather than just protecting a position.
I think it's a big thing to know who you're working with, isn't it?
Just about to say, it's like choose your financier right.
Yeah.
Same way you choose your legals right, choose your team that you work with and your brokers correctly as well.
Okay, gents, thank you very much for that. That's all we've got time for in this half of the show. So join me again after the break when we'll be talking to Ian Humphreys and Jamie Pritchard about more of your questions on finance. Hello and welcome back to part 2 of Property Question Time with Ian Humphreys and Jamie Pritchard. Right, Ian, your second question. I'm planning my application for finance for a fairly large residential development. I am trying to undertake what I consider to be self-inflicted stress tests, but the question of interest costs is a difficult one at this time. Do the panel think that rates have now peaked, bearing in mind the project will take around 2 years to complete?
Yes, interest rates, really interesting time at the moment. I think we are in unprecedented times to a degree. Inflation's high, rates should be going up, but as we all know that if they go up too high, we're going to put undue pressure on our financial system. Banks are going to collapse and we're all going to have to put our cash under mattresses again, which is going back to the dark ages. But I think, have they peaked? I think the answer to that is probably yes. They may go up at one more time, but then I think they are going to have to start coming down. There was one of the ex-MPC members I saw actually recently say that they felt that after 11 successive increases in base rate, that the bank now just has to take stock to see the damage that they've done on the economy. There's a lot of undue stress that hasn't been realised yet. If I'm on a buy-to-let mortgage at the moment, it's on a floating rate. My mortgage costs have more than quadrupled over the last year. That's got to be borne out, right? There's economic downside to that. So yes, rates have probably peaked or near their peak. But I think as a developer, and this perhaps underappreciated, is there are still fixed rate loans out there. So, pre these recent rate increases, you might have found 75% of the market would have given you a fixed cost of borrowing over loan term. That number's dropped dramatically, but there are still a number of lenders out there who will offer you fixed cost interest. So if you're worried about it, then you can still fix and get good value.
This business of inflation, I mean, I appreciate that the rates have gone up to, shall we say, calm inflation. Probably not cure it, but calm it. But I mean, throughout my lifetime, inflation has always been blamed on people taking too much credit, borrowing too much, putting too much on their card, overspending. But that's not the case this time, is it? That's not the cause this time. So it's not the Bank of England's only tool that they seem to have putting up interest rates. Isn't it a bit of a blunt instrument?
Yes. Yeah, well, yeah, but it's the only instrument they've got in the mainstay. So
well, yes, but if it's the only instrument they've got, isn't it time to have a look at something else?
Well, absolutely. They'll definitely have a look at what the policy should be on that. I tend to agree with Ian that the rates maybe one more increase, but they're pretty much stabilised from where they have been over the last 11 times that they have been increased. Inflation, albeit recently, has slightly increased, but all barometers are showing that will probably be down by Q4 of 2023.
To what?
I think
it's about 2.5%.
2.5%, 3%. I was going to pitch for.
But whether that bears out in reality, I'm not sure.
Quite optimistic.
It's really optimistic.
It is optimistic since the last month.
Well, it's quite interesting. Just coming back to the cause and the cure for inflation. I mean, it's quite interesting, isn't it? I mean, it seems to me fairly obvious that the war and the world's circumstances have played a part in this. Whether it's all of it or not, I don't know. But I mean, when you think about it, the government now, in this last week, seem to have changed their mind, and they're saying actually now inflation is being caused by older people going back to work.
Right.
And yet that's something that the Chancellor wanted to promote in the budget, wasn't it? So I'm at a loss.
Yeah, I think going back to a point about whether there needs to be new tools in the MPC's arsenal with regards to inflation, I think that's really valid. Because putting up interest rates can't be the only answer. And I think especially at the moment, inflation, as you rightly say, is caused primarily by global macro environment rather than the UK specific environment. So if we put the base rate up at the Bank of England, it's not going to stop a war in Ukraine. It's not going to stop the hangover from COVID. These are things that are beyond the MPC's control.
Yeah, I mean the rising costs of materials, which we talked about earlier in the programme. I mean, for instance, it's so complex. I did an interview with somebody who was a materials supplier, and I said the real problem is that because the Black Sea is now effectively shut off, the routes for timber coming from either Russia, from even the Nordic countries, is so complex now. The container costs and the transportation costs are just shot through the roof. So even if the material themselves haven't gone up that much, the transportation costs have. Yeah. So it's quite a complex subject, isn't it? And I don't envy you guys having to, I don't know what the word is, factor that in when you're assessing somebody's pitch, really.
Definitely, especially when the pitch is over maybe 2 years development, like you said.
Well, I think everything just comes back to the land price, doesn't it? If you pay the correct price for the land, you can afford these abnormals. If you pay too much for land, then you start getting yourself into trouble.
Well, I think that's right. And just to finish that subject off, I think the God-given right to think you're going to make money just because you bought property, I think those days are over, aren't they?
Yeah.
Yes.
The world's too complex, isn't it, really?
Definitely.
Yeah, I think people going in with that mindset are, going to get found out.
Yeah, I think you're right. Okay, thank you very much, Ian. Jamie, your question. I'm looking to purchase a property at auction, which to be honest has come a little earlier than I anticipated. It seems that a bridging loan would be the quick solution, allowing me time to look for long-term funding later on. Having never had bridging finance before, could the panel give me their top 5 tips for preparing the application?
Okay.
That's how do you get past Jamie then, isn't it?
It's how to work with Jamie.
Right.
It is,
okay.
all working together in harmony. Those auction properties always do come a bit earlier, don't they? And that's it. So I've got sort of two sides to look at this question, really, because to prepare your application, what you need is a good pack. What I mean by that is, your ID, all these documents that you will need to put together. A good broker will help you with that. So that's the second bit. Get a really good broker, and then a legal team around you. The broker will select the right lender because you've only got potentially 28 days to complete on that transaction as well, with your 10% at risk at the auction itself. What I'd like to sort of more go into, so it's getting everything, documents together and working with your broker. So broker will be able to help you with that. I think the deeper question to that is why they're buying that property, why they think they're going too early, and what they're doing. So are they reacting? Why are they reacting to that property? So are they doing the right due diligence on their property, and have they got the right business plan set out to what they want to do? Within that business plan, have they factored in what structure of ownership they want to buy properties in as well, and not try and change that later on? So a good tax advisor will really help them with that. We talked about in earlier questions about the rising rates of interest. Actually, with the tax changes for buy-to-let landlords in 2016, that was well publicised. I think that those landlords in personal ownership are feeling those pains more now than they would have been when that was factored through and tapered through over the preceding 4 years. So I think structure of ownership is really important. It's getting that real good legal team around you as well, and that broker support that we said. So all those things together is what I would say there. But picking your right lender would be key to this transaction.
Jamie, quite interesting. I was talking to Ian prior to us recording today's programme, and we were just discussing residential mortgages, and I said it came as a bit of a shock to me in the sort of, I suppose, 2007, 2008 period when I applied for another mortgage, and I said, I went to the provider that I'd been for 25 years before, with various different mortgages, and they said, well, yeah, so what? There was no loyalty had finished. Whereas before you'd go back to your existing lender, and because you'd been with them, because you've got a good record, you were almost 75% of the way there. But that loyalty sort of syndrome is gone, hasn't it? That there is no loyalty now.
But you could argue that loyalty got us into the problems in the first place.
Possibly. But what my deeper question is on that, you say get a good broker. Now, on Question Time, we have this so many times, and a lot of our experts will say, build your team.
Yes.
Do you view a broker-borrower relationship as a long-term arrangement, contrary to the sort of current lending sort of criteria? Do you build that broker into your team and keep him? That's my question.
Yeah, you can keep them. You can have multiple brokers, and what I mean by that is that you could have a broker that really understands the long-term market. So that broker that you went to see, he or she in 2007, may have been for your long-term mortgage, your 25-year mortgage. That broker may not be suitable for your development finance needs, or your bridging finance, or your commercial finance. So actually, if you can find a firm that houses that crack team of financiers and brokers in there, brilliant. And there are those out there. Actually, having one person that understands all that, maybe, I haven't found someone who's great at every single one of those aspects. Remember, what you're doing with that team is saving money, because you don't want to be doing something that you don't understand as much, but also you're saving time.
Okay.
So, you could say, well, I'm going to find out the companies myself. Well, there's certain tools around there, but are you going to understand it as good as the broker does, and actually to pinpoint that right lender at the right time, especially if you're under the stress of a window to completion of an auction finance.
Okay, lovely. Well, gentlemen, thank you very much indeed. That's all we've got time for today. So big thank you to Ian Humphreys, CEO of Brickflow. Thank you very much for coming in. Hope you've enjoyed your first outing with Question Time.
It's been great. You guys have been very gentle.
Good. Well, thank you for your answers. Very helpful. I'm sure our viewers are very grateful. Jamie Pritchard, Director of Glenhawk, thank you for coming in yet again with your knowledge and expertise. Thank you both very much indeed. I'm Stephen Galpin. Join me again next time on property question time.